Instead of investing in stocks or bonds or securities ourselves and trying to diversify and picking a few, this stock, a few of that stock, and mixing it all up and creating a portfolio, there's something called a mutual fund in the US or a unit trust in the UK, which basically allows us to achieve that objective and even achieve it more efficiently and slightly easier. So what's a mutual fund? That's the topic of this particular section. A mutual fund is a pool of money that's contributed by many smaller investors, or some large ones, but typically more than one investor, and most often even thousands or hundreds or thousands of investors, that contribute some money to create a large pool of assets that's then managed by an investment professional, who's also known as the portfolio manager or the mutual fund manager, and who basically makes the investment decisions on behalf of each of the investors in that fund and those therefore that have contributed money to the fund. Mutual funds tend to have guidelines by which they invest, and they tend to have a benchmark against which they're measured. So for example, a mutual fund might be a US stock market mutual fund, or a UK stock mutual fund, or a European equity mutual fund. And those guidelines decide and define what the portfolio manager invests in and how he's measured and what his benchmark is. So for example, a US stock market mutual fund might invest in the 500 most widely held companies in the US and might have as its benchmark the S&P 500 index. So it would typically hold the stocks in very close proportion to the stocks as they are in that index, the S&P 500 index. And what that means is that the mutual fund manager then would make decisions whether to over or underweight certain stocks within that index, maybe even buy a few that aren't in the index, but overall he wouldn't deviate too far from the index, because he would then have too much what's known as tracking error, and the risk of not having a performance that is close to the benchmark gets increasingly high. So he'll pick stocks around the benchmark, overweight those he likes and underweight those he doesn't like, with a view to beating the performance of the benchmark. The benchmark then, for example, could be the S&P 500. If it's up 10%, the mutual fund manager would have done a great job if he gets a performance of more than 10%. And the investors in the mutual fund can typically own units or shares in that mutual fund, and they'll benefit from that performance as well. So what are the benefits of mutual funds? Well, they tend to own a lot of stocks, so they provide diversification, and it would be difficult for us, for example, with $1,000 to own all the stocks that a mutual fund does, but we could own, a part of a mutual fund and then get all the diversification because of the money that's then pooled into a larger sum and buys hundreds of stocks potentially. We could never buy hundreds of stocks with $1,000. We have an investment professional that takes the investment decisions. We have better risk management, risk control system. So we can basically capture the performance of something that's very close to the performance of a particular index or market. So mutual funds tend to be a very good alternative for many investors, and form the basis for many people to have their equity holdings or their bond holdings through mutual funds. And it's particularly for those advantages that that's the case.